Hello and welcome to this bonus video training session. I'm Sandy Jadeja and I'm going to be with you for the next 20 to 25 minutes covering some of the basic techniques that we looked at on the 2-day trading workshop. Now, as with any forms of investments that includes trading or longer term investments, there are inherent risks involved, so please make sure that you fully understand all the risks that are associated with trading and investing, and if you're unsure, please consult a professional financial advisor. Now, just so that you're aware that the video that you're actually going to be watching is specifically for yourself. This is not to be shared with other people, including friends or family members or other members of the classes that you've attended with. It's not to be shared on the internet, on any of the websites. If we find that you're actually doing this, then you will be prosecuted. Now, you must have completed the 2-day workshop in order to understand what we're going to cover in this video training program. You also need to understand the risk management side, which we covered intently at the 2-day workshop. And of course, remember that the platforms vary, so please consult your platform provider should you have any questions on how to place trades or how to cover the order part of this video training session. Now, the videos are simply to remind you on what we covered at the workshop. As I said, this is not a complete training program. It's purely just a reminder. Sometimes you forget what you've learned at the workshop, and so the idea behind this video is to just go over some of the basic techniques on the strategies that we looked at. You may want to consider doing a 2-day resit should that help you. In the past, we have found that people have sometimes come back to do a resit on the program, and it's cleared any of the questions that they may have had. But hopefully this video should help you on covering some of the basic techniques that we're going to be looking at. Now, trading with a trend, we covered this at the workshop where we talked about a very specific type of trading which has been used over the years by many professional traders. It's been covered on various programs as well. But the idea is to look for a bullish trend, and as long as we have higher highs and higher lows, we want to look at buying on the breakout of the high. Now, if the bearish trend is lower and we are seeing lower highs and lower lows, then we're looking for the market to move down and looking for opportunities to go short. And what we're trying to do really is to either trade the break above the high to enter a move to the upside, or trade the break below the lows in order to capture a move to the downside. So have a look at this. What we can see on this particular chart here is we start from the low here, and then the market moves higher, then creates a higher low. You can see that this low is higher than the previous low, and then the market continues to go up. It goes sideways for almost 2 weeks, but you can see the clear low is this bar here, and that is obviously higher than this low here, and then the market again continues to go up, and then of course it's pulling back again over here. So what we're trying to do is really just buy the break of this high as soon as the market takes out the high, and we want to place our stop just below the low here. Then as the market goes sideways, we need to see a clear break above this high here and not go below this low. So the way that I do it is I will place an order 10 points above the high and a stop 10 points below the low. So once the market has broken above the high, then your order should be active. Yeah, your order should be active. And so in any case, even for example, let's say right now this market is coming down, I would wait until the market stops wherever it wants to stop, as long as it doesn't take out this low here, and then it starts to turn higher. And as it approaches this high, I would place a buy stop 10 points above the high, and I would put my stop 10 points below the low. And that's all we're trying to do here. We're waiting for the market to create the high, and as long as it keeps going higher and higher and higher, we would keep buying the breaks of the highs. Now this is a downtrend, so notice that there was a peak here. This was the highest point. The market came lower. It tried to break above this high but failed, and then starts to come down. So we actually want to place a sell order 10 points below this low, which this bar would have triggered your order. our stop would be 10 points above the high. And as you can see, the market starts to trade higher but fails to break out this high, so you shouldn't have been stopped out. Then as it starts to go lower, I then want to sell below this low, 10 points below this low, and it gets triggered here. So my new stop is here, my previous stop has been here, and I would lower that stop to add it to this stop here. So I've got two stop loss orders here. I'm short here and I'm short here. Now the market comes down quite rapidly. We're short two contracts or two positions, and the market starts to go up. We don't want to panic because it hasn't taken out this high. Then as it starts to come down, I want to sell the break of this low and not see the market go above this high here. And then of course the market continues to come down and so forth. So we keep selling the breaks of the lows. And so this is the simple way of trading with the trend on the higher highs and the higher lows, or in this example we have the lower highs and the lower lows. So trading with the moving average indicator, this is a slightly different technique. We still want to trade with the trend. In other words, we're trying to capture the dominant movement in the market. Now you need to decide on whether you want to use a 10 period, 20 period, 50 period, 100 period, or even a 200 period setting. And again, you trade with the overall trend and use risk management as we covered at the workshop. So here's a 10 period moving average, and you can see that the market over here has closed above this blue line, so you would actually enter a long position. Now your stop could be at the low of your entry bar, and the only way you would exit this position is once the market has closed below the moving average, which it has done over here. So you would exit for a profit on this trade. So do you go short? Well, if you're seeing higher highs and higher lows, then you would not establish a short position. Instead, you would wait for the market to close above the blue line, which it has done over here. So we're now entering a long position, and we exit here. We enter a long position, and then we wait for a close, which happens over here. So that's basically a 10 period moving average. And this one here, you can see that the 20 period has given you less signals, but it's exactly the same market. In other words, the only thing that's changed is this 20 period moving average setting. But otherwise, everything else remains the same. Now take a look at this. This is a Dow Jones weekly chart with a 50 period moving average of the closing prices. So you can see this green line, that's the 50 period moving average, and the black line is actually the closing price only. It does not have the open, high, low included in this particular chart. It's only the closing price. And you can see in March 2016 the Dow Jones closed above this green line, and at that price we were looking at 17,213 to enter. Recently the market had reached a high of 22,092. So the difference between 22,092 and 17,213 is your current profit. So how would you have managed the stops on this trade? There are different techniques which we covered at the workshop, and in a very simple manner, just for this video, you could actually just wait until the market closes below this moving average to exit your entire position. Now remember, this isn't going to work perfectly. There are times, so for example, if you had gone short here, the market closed above the moving average, and that would have been a losing trade. And across here, this section, the market had actually traded sideways, so that would have provided you with a few losing trades. This short position up until March, that would have given you a fairly small size profit, but enough to cover some of the losses that you had recently. And of course this current move from March 2016 all the way up to here is in a very, very profitable position. So that's basically using a moving average with closing prices only. So again, you need to decide whether you want to use a 20 period, 50 period, 100 period. All depends on your trading plan, and this is something that we covered at the 2-day workshop. Now the combo, this uses a very simple 20 period moving average. It's not an exponential or any other form of moving average. It's just a simple 20-period moving average, and then we've applied the MACD indicator as shown in the class and the settings you were given this in the workbook. You can actually use daily and weekly charts. They provide clearer signals. You've not been taught how to use this on the intraday basis. So have a look at this. This is a Euro Yen. It's a daily chart, 20-period simple moving average with the MACD. So what we're looking for is for the market to close above the moving average when the MACD is bullish, as you can see here. So you would have entered here on the close of the bar, and as soon as the market takes out the high, we would be long, and our stop would be below the entry bar. And then you stay in this trade until the market closes below the 20-period moving average. That's the basic technique. There are some variations which we covered in the workshop, but for the purpose of this video, you would actually just wait until this market has closed below the moving average. For example, here you can see the MACD was bearish, the market closed below, and then it eventually closed back above. So that would have resulted in a losing trade because the market closed higher than where you entered. But again, in the workshop we covered some very simple techniques for exiting much faster with a profit. And so again, if you want to reset the workshop, then of course contact us and we'll try and find you a place at the next available workshop. The HE2 and time windows. Now this is a very different technique. It's something quite unique. You would actually wait for the dates which you are going to receive for 1 year, and at the end of the 1 year you can just simply resubscribe to get the dates, and on the actual date you would apply the buy stop and sell stop orders that we talked about in the workshop. And the idea is to capture a short-term trade using very specific dates and using the buy stop sell stop orders, and you could move your stop loss to break even should you wish to do so. So let's take a look at this. This is the price bar, and there are 4 components here: the open, the close and the high and the low. And what we're looking for is the break of the high or the break of the low. We're not interested in the open and the close. So for example, this vertical line, you can see that that was a very specific date that we were looking for, and we would have placed both a buy with a stop here and a sell with a stop above the high. Again, I use a 10-point rule: 10 points above the high to enter, 10 points below the low to place my stop. At the same time, I would place a second order, a sell 10 points below the low and a stop 10 points above the high. Now all I'm looking for is a breakout, so that means that on that date when we place the order we wait for the next bar. So as you can see, the second bar has triggered a short order and it hasn't stopped us out. The blue line at the bottom is where our target is, which is 100 points, and it took 1, 2, 3, 4 bars for the market to reach a 100-point target. So there are 2 ways to do this. I personally would just place a limit order 100 points away just to bank the profit. But if you want to manage the trade, as we showed in the workshop, that's entirely up to you. But with the HE2, I tend just to bank the 100-point profit target. Now in the time windows, that's something a little bit different. Because the HE2 typically takes anything between, I would say, 1 to 7 days to reach the profit target, the time windows, it works in exactly the same way as the HE2, except that it lasts anything from 2 to 3 weeks. So what I tend to do on the time windows is not to set a limit order. I would actually just manage the trade manually. So let's say, for example, in a time window we had the sell order triggered, then I would look for bullish bars to exit my trade, and we covered that in the candlesticks method in the 2-day workshop. So this is just to show you the simple concept of we wait for the specific date, which is this vertical line, and on that date at the close of the market we are looking to trade the Dow Jones, Wall Street. So in the UK the Dow Jones closes at 9 p.m. and so just 1 to 2 minutes after 9 p.m. I would place both my buy stop and a sell stop order, and then a profit target of 100 points either way, whether it goes on to the upside or to the downside, and that's it. Now once the order has been triggered, one of two things will happen. Either it will reach your profit target or it may not reach your profit target. So let's have a look at some examples. You can see in this first example it had not reached the profit target, which is the second blue line here. It had reached the first blue line, and that's the 50-point level. So in the workshop I talked about if the market reaches 50 points, you could move your stop loss to your entry position, and that way if the market reverses it doesn't cost you anything. In other words, it's a free trade. So as you can see in this first example, it had not reached the 100-point target, but it had reached the 50-point, and if you'd moved your stop, this trade wouldn't have lost you any money. Now because we don't close the position, or we don't close the order on the other side, what happened here is the market reversed and it triggered the buy order on the upside, and then 1, 2, 3, 4 days later it reaches that green line, which is the 100-point target. So with the HE2 method, you wait for the specific date, and at the close of the market on the Dow Jones, which is 9 p.m. UK time, in your country it would be a different time, you simply place the buy stop, sell stop order with your profit target of 100 points on both the buy side and the sell side, and then you wait for the market to trigger your order. If the market moves 50 points in your direction, you can simply move your stop loss to your entry level, and if the market doesn't reach the 100-point target and it reverses, that means it will then trigger the order on the opposite side, and you apply the same rule. If it moves 50 points in your favor, move your stop loss to entry price and wait for the market to reach the 100-point target. Sometimes the market will just stop you out with no profit or loss because the 50-point rule was used. If you hadn't used the 50-point rule, then of course if the market doesn't reach the 100-point target, then more than likely it would have stopped you out for a loss and then triggered the order on the other side. So with the time windows, as I said, we don't use a profit target. We simply manage the trade manually, as we discussed at the workshop. Now candlestick patterns, I'm really just going to cover the very basics here, but we spent a considerable amount of time on candlesticks in the workshop, and you really just want to learn the basic candlestick patterns. Observe the overall trend and use the order system, which basically means use the buy stop and the sell stop method at 10 points above the high and 10 points below the low. The larger time frames provide clearer patterns. In other words, if you try to do this on 1 minute, 5 minute, 10-minute price bars, you're going to get very noisy entry and exit signals. I personally prefer to use minimum daily bars, if not then the weekly and the monthly. So have a look at this. This is the Euro-Yen monthly, and at the bottom you can see this white bar here, and that body is inside the previous black bar, and so we call that the harami. Because it's white, we're expecting a bullish move, so we would place a buy stop order 10 points above the high, and as you can see the market took out the high. Our stop would have been below the recent low, and then for 1, 2, 3, 4, 5, 6 bars the market moved higher before creating this black bar. We would then move our stop loss to 10 points below that low. We never got stopped out, the market actually moved higher. So this is just a very simple technique we discovered in the workshop, and I hope that you find this useful. This is the pound dollar, and again what we have right at the bottom of the move, you can see that the white bar again is a harami, and so what happened, we would place a buy stop order. The market continued to go higher. We then see this black bar, which is the time for us to move our stop to 10 points below the low. It didn't stop us out, it kept going higher until the second black bar came about. So we would then remove this stop and put it to 10 points below that low, and then the third black bar stopped the position out. And as you can see, that was a profitable trade, and that made 4,780 in 4 weeks. So a really very simple technique to apply. And the reason I'm saying 4 weeks is because we actually moved the stop from the very basic low to the 4-week low. Okay, so that's 1, 2, 3, 4 weeks. And so in other words, we wouldn't have really faced any major risk here. There would have been a small risk compared to our previous stop loss from the high to the low. But as the market continued to move higher, 5, 6, and 7 weeks, we would have banked the profit. But in the workshop, I showed you how to manage a stop, which is why we applied the 4-week rule here. So what you've learned so far, it's a very simple technique of following the trend, which is the higher highs, the higher lows, or the lower highs, lower lows for a move to the downside. And also how to apply a simple method with a simple moving average. Then we looked at the combo method with the 20 MA and the MACD. And we looked at the very bare essentials of the HE2 and time windows, which is covered in great detail at the workshop, and of course the basic application of the candlestick. So I hope that this has just really jogged your memory, provided you with a few reminders of what we learned at the workshop. Now, just some additional notes: do not overtrade your account size. This is where I find people lose money because they're overtrading. Make sure that you're trading a small percentage of your account. Do not try to trade too many trades at once. Don't try to have 4 or 5 trades open, one on the combo, one on the moving average, one on the HE2. Just really focus on one trade at a time. And then managing your risk and your emotions is really, really important. Be prepared for losses and remove the emotions attached to the loss. Remember that trading does have losses. You cannot keep trading with wins. You will have losses along the way. And this is a long-term business, not an overnight success. In other words, you have to look at this for the long term. Don't base all your profits and losses just on 1 or 2 trades. Now, you've got to learn to do your own thinking and have self-reliance. You cannot really start asking other people questions on what markets they're trading and what they're doing. You really want to focus on your own personal trading style, your personal trading strategies. And then you don't really want to be talking about your open positions or even your ideas with other people, because if they say something that might sway you to maybe miss out on a trade, it might cause you to think about something else, and eventually you see your trade working out and you missed it because you were listening to somebody else. So try to keep your analysis to yourself and do not talk about trades with other people. Sometimes you'll find that the fear factor is stopping you. That means that you're scared, and we run a 2-day focus group program which is really designed to help you to uncover what those fear factors are. But you need to learn basic trading psychology that can help you improve your trading skills and also to help you remove your fear factors. Financial understanding is another factor which scares people. In the workshop, I talked about how we keep everything simple. You don't need to learn everything about the financial markets. You can get started with just the bare essentials, the simple techniques, and that can help you, and later on you can start improving your trading strategies. Follow through, that means that once you've learned these techniques, you really do need to apply these. You are not in a good position if you're sitting on the sidelines or maybe even just doing some paper trading. I personally always have believed that even if you start with a small account and trade with real money, but with very, very small size, it at least puts you in the motion. And once you start uncovering those emotions, then you can learn how to deal with how to become a better trader. But all of this is trading psychology. Again, cover this in great detail at the 2-day workshop. Any questions? You're part of a chat group. You can send an email, although I am quite slow at responding to emails purely because there are just so many emails coming through, and hence that's why we have the chat groups. But I hope that this video has really just jogged your memory on some of the techniques that we covered at the 2-day workshop, and that it's been useful for you. I look forward to seeing you at a meetup and obviously continuing to provide you with support on the chat group. Thank you very much for your time and hope this has been useful for you.